Hello everyone, this is Kevin Zhao. After reading this chapter, you should be able to understand the difference between technical analysis and fundamental analysis, to evaluate some typical techniques used in technical analysis, and to decide what role technical analysis might play in your investment. Technical analysis uses market data to analyze both aggregate market stock prices and individual stocks. It ignores the fundamental information such as sales, earnings, growth rates, and so on. It pays no attention to stocks' intrinsic value. In some extent, it casts insight into the psychological dimension of the market. For example, the impact of investor sentiment on stock prices. Technicians believe that supply and demand result in particular stock price pattern. Stock price charts are of great value to identify trends and patterns and to detect trading signals. The Dow theory is the oldest and the best known theory of technical analysis. It defines three types of stock price movements: primary move, secondary moves, and day-to-day moves. The Dow theory suggests that the bull market occurs when successive rallies penetrate previous highs and declines remain above previous lows. It also suggests that the bear market occurs when successive rallies fail to penetrate previous highs and declines penetrate previous lows. The Dow theory defines secondary moves as technical corrections. It believes that day-to-day moves are of minor importance. The Dow theories aim at forecasting the starting point of primary moves. It's a very attractive theory for investors. However, the success of its implementation is questionable. The same market data may suggest conflicting movements. This graph demonstrates an example of primary move and a secondary move based on the Dow theory. Technical analysis tries to identify the trend of stock price movement by identifying the trend line between the supported level and the resistant level. Both the bar chart and point-to-figure chart can be used to identify stock movement trends. The moving average is one of the most popular technical indicators used by technical analysts. Comparing the short-term moving average and the long-term moving average can generate trading signals. When short-term moving average crosses the long-term moving average, it indicates that stock price will move up, sending investors signal to buy. When short-term moving average crosses the long-term moving average, it signals a sell. Relative strength is the ratio of price to index or past average price over some period. Rising or falling ratio indicates relative strength or weakness. Breadth indicator measures the net difference between number of stocks advancing and declining. Plot of running total across time is compared to a stock average to analyze any divergence. Divergence implies trend changing. High trading volume is a bullish signal. Short interest is the number of stocks that have been sold short but not yet bought back. Short interest is a typical investor sentiment indicator. Generally speaking, high short interests is a bearish signal and a low short interest a bullish signal. Yet, sometimes high short interest may be explained as a bullish signal because more short positions need to be covered in the future, and the stock price may be boosted due to short covering. Contrarians trade in the opposite way of most investors based on the belief that if most investors are buying or selling into stock, then the stock's more likely to be over or under priced. Bearish sentiment index is a ratio of bearish financial analysts to total number with an opinion. Typically, the bearish trend is identified when the index is between 55 to 60%, and the bullish trend is hinted when the index is above 20%. Put call ratio is the ratio of number of traded put options to the number of call options. Assuming call or put option investors are bullish or bearish about the market trend, then high or low put call ratio suggests a downward or upward market trend. So far, we introduced the 9 different technical analysis techniques. Do they work consistently for investors? To test the effectiveness of those technical trading strategies, we needed to look at many factors such as transaction costs, risk, and consistency in performance. Unfortunately, academic studies generally do not indicate that technical analysis works. Efficient market hypotheses pose many challenges to technical analysis, yet there are some new evidence supporting technical analysis. For example, the momentum trading strategies that academics discovered in the late 1990s. To conclude, although technical analysis is still popular among individual investors, there's no consistent evidence suggesting its long-term success. Most technical indicators may lead to conflicting explanations. The weak form market efficiency hypothesis suggests that technical analysis is of no use in forecasting stock price. This is Kevin Zhao. I hope you enjoyed this video, and I'll see you in next class.